Welcome back to another roundtable. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi everyone.
Thank you so much for joining us today. We're going to discuss the 5 signs to tell that you're not ready to invest.
Yeah.
So, I mean, a lot of times people always want to invest, right? I mean, you watch this channel, you're looking for ways to invest. What stocks can I look at? REITs can I look at? But doesn't mean that you're actually ready to invest.
Yeah.
Yeah, there's certain things that you need to know about yourself and your personal finances before you actually take the plunge into the stock market. So we're going to discuss the 5 signs. What is the first one?
If you're below 18 years old.
I mean, that is legally true, but I know of people who have started when they were
16,
much younger.
14, yeah.
Okay.
You can use the parents' account.
Yeah, that's true. Yeah, but okay, what's the first one?
All right. Yes. If you have no money, basically when I say no money, when you don't have emergency that's set aside.
Yeah.
Right, emergency fund. All right. So this is the fund that's really important for you to stand by in the event where anything happens to you. You could use that emergency fund to, pay for it. Right. But if you invest that money, and then if something happens to you and the stock market plunges and you have to force sell your position, and you'll suffer a huge loss.
That's a risk because you don't want to be caught in that situation.
Correct.
Yeah.
Yeah. What if it's a market crash? COVID happens. Correct. I mean, COVID was a perfect storm. Let's say imagine COVID.
Yep.
You had no savings. And then you invested before COVID happened.
Yeah.
And then everything crashed. And then you
out of job.
You can't out of a job. You can't work. No one's working. Economy's not moving. And then you need that cash. And then it's the worst time to sell.
Yep.
You don't want to be stuck like that. So you need some savings, emergency funds.
So we did talk about this. The rule of thumb, I think, is about at least 3 months of your money expenses. Once you set that aside, at least you have a rainy fund that you can use it anytime in the event of emergency.
Yeah, 3 to 6. 3 months is the bare minimum, but try to work towards 6 months.
Okay, so that's number 1. So you must have some funds just in case. Number 2 is to clear your high interest debt.
Yeah. You don't want to help the bank to compound their wealth. You want to compound your own wealth.
Correct.
So you actually clear off all those high interest debt, like your credit card debt, your student loans, and all this, right? So once that all settled, you got a peace of mind, right? Then you are allowed to really invest in the stock market.
Maybe let's break down the number. Like credit card debts nowadays, the interest they charge is about, I think, 24. Used to be 24%, right? And nowadays it's about 28% I'm getting from my credit card companies. And if you try to invest, and usually the best return that you possibly can get over the long term could be maybe 15%.
Buffett I think is 19%.
Warren Buffett is, if you're Warren Buffett.
Yeah, if you're Warren Buffett.
And there's only one Warren Buffett, right? So let's assume that you can get 15%. And then you have expenses that are actually leaking out, which is your credit card bills that actually is costing you 24% to 28% a year.
Yep.
Right? I mean, it doesn't make sense. You're still losing money.
Right?
So that part, the interest, you have to clear it off first.
Yep.
If you have a mortgage with a low interest rate, like 3%, 2%, fine. Yeah, you can keep it, right? But make sure you clear all those higher interest rate.
Yeah. So no point paying 20% in finance costs basically.
Yes.
And then only making 10%, 15%.
Yes.
Doesn't make sense. Yeah. You're not getting anywhere. You're actually going behind.
Yep.
Yes.
So you need to clear that. So that's step number 2. I think this is pretty clear. I think we talked a bit about this before as well.
Yep.
So step number 3 is how do you know you're not ready to invest?
You're afraid of volatility.
Yeah.
Okay. I think that's the one of the major things that really caught people, I think, right? Because if you look at the average stock market fluctuation, right? Let's say the S&P 500, it can go as low as dropping maybe 3% to as high as 20% or more, 50%, right? But most of the time, right, on average, they will be ranging between 3% to 20%. The average stock market bear is like 20% or more, right? But most of the time, they'll hit the 20% mark, right? If you are someone who very afraid of volatility, right? When the market plunge 20% and your stock plunge 20%,
which is actually quite normal.
Yeah,
it happens.
Correct.
Yeah.
So, and you panic and you sell, right? You're going to prematurely, take your investment out of the market.
It's literally the definition of buying high, selling low.
Yeah, correct. Right. So I think before you even invest in the market, you have to accept the fact that the market is volatile, right? The stocks will go up and down, right? As long as your company, right, is fundamentally strong, right, and you know that the business is strong, you don't sell it, just hold it, right? And eventually you know that you'll recover because of the fundamental strong. I've known someone who invested 100% of his fund in the stock market already, right? Before the 07 before the 0809 crash. The crash happened. His portfolio went down 50%. He didn't sold anything. He just hold on, and eventually it just recovered back. Right? I mean, this person trusts his portfolio. Right? So,
was it you?
it's not me. Right? The only thing I did was I bought Facebook. I remember I bought about 148. It went all the way up to 300 plus. Then the last year, you went all the way down to 90. I didn't sell.
Okay.
Right? You went back now 300 plus. Right?
Yeah.
So I at the end of the day, it's still, you must know what you're doing.
Yeah.
Because if you don't know what you're doing, the volatility really will hurt you. Right? If you know what you're doing, then probably the volatility is
your opportunity.
It's just an opportunity for you.
Yeah.
Right?
And Victor can say that because he already have strategy in mind. He's a long-term investor. That's why he uses this strategy. For someone who is trading, that could be very different.
Okay. That's a different strategy altogether. But I think, in the context of what we normally do in our channel, I know of people who, they understand the philosophy. I buy high quality companies, I hold them the long term, but every time it drops 20%, they go like, why did I buy that stock? And I was like, you know what you're buying, right? It's a great company, right?
Yeah.
And you plan to hold it for like 10 years?
Yeah. But my thinking is that when the stock dropped 50%, right, does not mean that you are wrong. Right. That's the most important thing that you. But of course, if really the
you could be
fundamental
wrong sometimes.
But you must go assess it,
the fundamentals,
whether the fundamentals is still there. If the fundamental is still there, then it does not mean you're wrong, right? But if the fundamental is not there, then of course, I think you have to reassess the thing, right? But of course, there's also cases where you think that the fundamental is there, but it's just not there, and you think that you're right, and you continue to hold on, right? So at the end of the day, you should slowly build up your knowledge, because once you have the knowledge, right, you can ride through the volatility. But if you do not have the knowledge, right, you can't ride through the volatility.
All right. So one simple way you can find out whether you're afraid of volatility is like you kind of look at your portfolio and close your eyes and you imagine, what happens if this stock fell by 5%? 5%. You're like, most people are like, okay, no problem. Drops by 10%. Yeah, okay, no problem. Drops by 20%. Then you go like, I don't like that. And then if it drops by 50%, you go like, oh. So some people really cannot take it. And it's fine. If you can't take it, then invest in a different way. But you have to be aware of where your line is. Because it's going to be volatility. So that's step number 3.
I know of a person where I think he told me that he is comfortable investing 5-figure sum in the stock market, and he can live with it if it goes down. The stock portfolio goes down by 50%, and then it can go up. But the moment he put on 6-figure on that portfolio, he said he can't even take it. The portfolio drops 20%.
Interesting.
Yeah,
so it's very psychological.
Correct. So this is, if you're knowing your own risk where it lies, you can actually kind of adjust your portfolio accordingly. Because you don't want to invest beyond the risk that you can take. Because when it happens, it usually happens in the stock market, right? You panic, and the moment when you panic, you will sell.
So he has a $99,000 portfolio. Everything else goes into fixed income.
Yes.
I think because he looks at because as your when your capital is low, right, you look at the absolute amount. Right. So your 10,000 drop half 5,000 is okay. But when your portfolio start to grow big, right, you should not look at the absolute amount. You should look at the percentage.
But some people can't do that.
So you have to train. All these have to train. When I started out, I'm not like this also. Right. But as the years goes by, you keep staying in the market, you keep training, you go through many crises, right? You will build it, right? But if after one crisis you give up, you will never build that emotion to fight all this volatility.
But that's a good point that Rusmin brought up, and you're carrying on, because like 50% of 100K is 50,000 people. Okay, I can make that back in a year. But if I have a $1 million portfolio, 50% down is $500,000. It's 10 years of my life. They really go like, so they can't do it. So. It really depends on what you are. So you got to be clear about that. So that's number 3, to know whether you're ready to invest in the stock market or not. So number 4 is
no financial goals.
Okay.
When you invest, you must have a target, right? You must have a target board to achieve. But your target board have to be realistic, right? So let's say you are saying that you want to invest, you want to make 1 million in 30 years. That's a realistic figure. By saving and investing in the market, over a long term, you should hit $1 million, right? But you will say that I want to make 20 million in 10 years. Then probably what you do now
20 million
probably is like, not the right, your income maybe is not high enough, right? Then you have to think of something to increase your income, right? So you have to be very realistic of the amount that or the goals that you want to set, right?
With the amount of resources that you
Yes,
have, right?
correct,
To get there and everything.
Yeah, either you increase the resources or you shift your goal, you know?
Yeah. The other thing is that everyone has very different financial goals also, because some people could be looking for income, dividends, passive income. Yeah. Some people are looking for growth. Some people are looking for capital preservation. It really depends, and that will decide the kind of like stocks you will buy. Because everything is, I mean, stocks is just one thing, but when it comes to the universe of stocks, there's so many different things as well. Yeah. So your financial goals will make a difference. Yeah. So dividends, REITs, and all that really makes a difference. All right. Okay. So you need to set your financial goals and know exactly what you're looking for, and then that will decide what you buy. Okay, so number 5 is
you got no idea how to invest.
Okay, this is a biggie, right?
Yeah.
So if you have no idea what you're doing, you're gonna lose money.
Correct. So the knowledge is important because it helps you with the volatility.
A lot of times people associate risk with volatility, right? So if the share price goes up, you make money. If it goes down by 10%, of course you will lose money. That's what they say, right? But actually that's not true. Volatility is always there in the market, in the stock market, okay, and people tends to associate with it. But what I see risk is actually come from not knowing what you're doing, and that's actually said by Warren Buffett. Okay, and I find it's quite true. If you don't know what you are holding, the stocks, you hear from someone say this stock is good, it go up from $1 to $2 in the next 3 months, and then you buy it, but the next moment there's a lot of bad news in the market, and then it came down. But you don't know what you're buying or why you're buying, and of course that can be very scary. And you have no strategy that you're backing it up. You're just buying because somebody say this stock is good, and then you don't know how long you're going to hold it. So you don't know, really have no idea, you're lost. Okay, so you don't want to be in that category. And what I will suggest most people is, if you are starting up, if this is going to be your first stock that you're going to buy, before you do that, go and pick up yourself the skill, the knowledge, right? Go and pick up some books, in the library about investing, right? And I think for a lot of strategy that I come across so far, I think long-term investing strategy work the best over the long term.
It works for most people.
For most people, mass market, and it's proven, all right. And over the short term, the stock can go up and down. But over long term, if you invest in good stock, usually you go up, right? So go and pick up and learn, read up books. I mean, we have recommended books before. Yeah. So I think One Hour on Wall Street is one of those good books that you can go and read it. Any other books that you guys have?
I think if you want to acquire any knowledge, right? I think I read it somewhere. The method is to just take up 5 books and you read that 5 books on that particular topic. So if you are interested in long-term investing, read 5 books on long-term investing. If you are interested in trading, read 5 books about trading, right? So after you read the 5 books, you should roughly get a basic structure of how this actually works. Right? Then after that, okay, which one really suits me and which one is what. Then from there, you pursue even deeper on that specific subject.
And if you can't get through 5 books, then,
some people don't read books.
Then I mean, that's one thing. That's a good point. Some people are more audio visual learners as well. But if you can't read 5 books, it kind of like tells you that maybe you're not too interested in something like that.
It could be, or sometimes it could be just too busy to go about it. So, and that's where I think we come in, right? We actually have courses where actually we record it in the visual format. It's like watching a YouTube video like now, and then you can just sort of like listen it through, and like how we actually go through the whole process. The
way I would compare this is like the difference between reading a textbook and having a lecturer explain it to you in a lecture hall. I learn so much better when someone's just explaining it to me, telling me the concepts, even though it's the exact same thing. Reading the textbook is very dry.
And when you have a question, of course, textbook can't give you that answer, right? So when you have someone to talk to, right, and this is where you can actually get the question answered. So we do have courses. I mean, it's not open right now. I think like Dividend Machines or Alpha Quadrant. Okay. So, but this is just one of the avenue where you can get yourself trained and educated.
So, but if you like we are audio person, right? There's Spotify, there's a lot
podcast.
So it's not just us. I mean, you have YouTube channel and all that. If you're interested in our courses, Dividend Machines and Alpha Quadrant, do check them out when they're open next year. So now we're closed already for the year. Do look out for them if you want an email newsletter as well. We'll talk about them on YouTube as well. But you need to know what you're doing. You need to have a framework, a process of some sort that you can fall back on and rely when you're picking a stock, making a decision to buy or sell.
I would say it's system.
It's
a system to produce.
Because if you are going in blind, like just throwing darts, you could get lucky, and most of the time you will get unlucky.
Yeah.
Because it's a random chance. And if you're doing that, you're not ready to invest.
Yep.
Yes.
Yeah, you must have a system. Yeah.
Yeah. And you must be above 18 years old.
Above 18 years old. All right, so these are the 5 signs that if you don't have these things or you're not ready for these things, you're not ready to invest. Number 1 is basically you must have emergency funds. If you don't, you're not ready to invest. You must clear your high interest debt. Number 3, you must be ready for volatility. If you're afraid of volatility, you're not ready to invest. Number 4, you have a financial goal, so you know exactly what you should invest in.
Strategy you use.
And the strategy you should use. And number 5, you need to learn that strategy basically.
Yes.
So you don't have these things, you're not ready to invest. Don't jump into the stock market because there really is no reason to jump in. Yeah. It's much better to just save your money, figure it out, and go in with a higher probability that you're going to succeed.
You can always put in the government saving bonds.
You can put in other things. In the meantime,
learn investing while your money is still compounding in the government saving bonds, right?
There's no need to go.
No rush to deploy your cash, even though inflation can be at all-time high. There's no hurry. Okay, I mean, I always think that that is, if you have nothing to do with the cash, then sit on it. Don't do something stupid with the cash.
I think the more rush you are, the more mistake you're gonna make.
Yes. There's no need for that. All right. So I think that's pretty helpful. These are the 5 signs to know that you're not ready to invest. Is there anything else you want to add, guys?
No.
My name is Adam. That's Rusmin. That's Victor.
Thank you
so much for joining us. Any questions about this, put them in the comment section. If you like this roundtable, hit the like button. Tell us we're doing a great job. Of course, subscribe to our channel. Many more roundtables come up, and we'll see you again.